Hi there, Serial Trader here. Let's do a weekend update here for the major US indices and starting off with SPX. So looking at the Elliott wave chart, big picture, nothing has changed. We still potentially have this significant top at 2860.31, and that could either be the top for a five-wave structure for wave C of an expanded flat wave 2, and then the implication is that we're coming down in a precipitous decline soon, or that could simply just be the five-wave top of a initial impulse wave after completing a three-wave correction into the December lows, and now we're just looking for something a lot less threatening, just a more corrective pullback that will set up for another long opportunity to ride a new wave to all-time highs. At this point, it's unclear which scenario is preferred, as nothing has really changed on the bigger picture outlook here. Like this daily chart, there's no new information as far as invalidating or confirming a certain Elliott wave count. So with that, I'll defer to what we've been looking at intra-week here. So basically, this down move that we've had, which basically all happened last Friday, we've essentially spent the entire week this week just digesting that, and it looks like we're just doing a correction of that. It looks very corrective, choppy, unfolding in three waves. It certainly doesn't look like the beginning of a new impulse wave that we're going to immediately take out this 2860 level with. So on this 30-minute chart, this is kind of what I'm seeing. Looks like we have a five-wave decline that mostly... most of this move was last Friday, and then I believe we early this week kind of made some slight new lows, and ever since then we've been correcting. So five waves down, possibly for an initial wave 1, or if we are just correcting and setting up another bull wave, a wave A, and then we have a three-wave move up in what's a larger wave A, so ABC for A. Then we have ABC down for wave B, and now we have a 1, 2, 3, 4, 5, as it can be counted, into potentially wave C of that larger wave 2 or B. And now the next move of significance that looks likely here is going to be another five-wave decline in either wave 3 or C. And obviously, if we just come down in a very orderly fashion and we don't really start tanking, then it's likely just a wave C, and that'll lead to a great buying opportunity. Or if we do start dropping heavily and go a lot further than we did in wave 1 or A here, we can start embracing that we have something more impulsive unfolding in some sort of third wave. But until then, it doesn't really matter. It looks like the trade to make here is to go short, obviously with your stop just above this level, 2860. So right now, you're not even risking 30 points on the S&P futures. So that's pretty decent risk reward if we are going to get a nice decline down to at least a low below what we've made here, which was at 2785. So I do like this structure, and you can see this AC equality relationship. So this A off of this B out to C, we've gotten slightly above that. That was at 2832. So the structure looks pretty mature. You can see this parallel trend channel. We're basically right up against the upper boundary line of that. And we're also in between the 618 and the 786 retracement of this overall initial decline. So it looks pretty ideal here to have one more leg down, at least in a wave C, and that's in the more bullish scenario. And obviously, if you go short here and you get stopped out, then something else is going on. But this at this current point, the pattern certainly looks vulnerable to another wave of selling. And really, risk reward, you're risking 25 or so points at this point, at least as of the close here on Friday. So risking 25 points, and your target is a minimum of 50 points or so. So even if you just made that very, very minimum objective of matching this low at 2785, that'd be about a 2-to-1 risk-reward ratio, putting your stop just above the 2860 high. And likely, we'd likely go quite a bit lower than that even in a C wave, we'd exceed that low. So you'd probably be closer to 3 to 1. And if we just, do a little projection here. So let's say that we completed our wave 2 or B up here, and we immediately turned down there on Monday. Well, if we just look at the equality relationship, which would be a high probability target for wave C, that would get us to 2761. So that's pretty good. You'd basically be risking about 25 points to try and make 75 points, and the probability of success seems quite reasonable given the fairly clear pattern here, this impulsive decline followed by this corrective rally into a fairly typical retracement area. So that's a pretty decent trade here short term. It's certainly one that I've taken there. I'm just holding, I think, just one ES contract short over the weekend, obviously with my stop above the equivalent high on the ES futures. It's just a few points above that, as there is a premium on the futures currently on the June futures. But that's a pretty decent play. And then if and when we do come down here, we're going to observe what kind of decline it is. And if we do just come down, like I said, in a nice orderly fashion near that equality relationship, and we start reversing, and it looks like we just have an ABC down, well, then it's time to go long for possibly the beginning of a new wave to challenge those highs, all-time highs. But at this point, we'll just see how the short term unfolds and go from there. Okay, now given that, I'll go to the Thinkorswim candlestick chart. And, okay, so if you were to completely ignore all that short-term wave analysis, well, what do we have? We have a decline. We got below the T-line. Some pretty indecisive trading here with the candlesticks. Doji. This was a bearish engulfing with a long lower shadow, though. And then another doji. And then invalidated that bearish engulfing by getting above it today. And obviously we did a bullish hammer, and we're back above the T-line. So just going by the candlesticks here, it looks reasonably bullish. But that's not enough information, and the short-term wave patterns give quite a bit more to go off of. We do have a golden cross here, potentially about to start. And that's where the 50-day simple moving average crosses above the 200. So that's certainly a positive technical event. And it would require a fairly immediate and sharp decline to prevent this golden cross from happening, although that's certainly still possible, especially given that short-term wave outlook that I presented. Now, if we look at the weekly here, weekly candlesticks on SPX. So last week we had that inverted bearish hammer, but now if you look at this week, so yeah, we went a little lower than the low of last week, but obviously we've recovered from that, and we actually did a weekly bullish engulfing candlestick. So going off of the candlesticks, both on the daily chart and the weekly chart, this actually looks pretty bullish and looks like we're just going to continue higher. But even if that does happen, I think on a short-term basis we look a little bit vulnerable there, given how clear that shorter time frame wave pattern is. But we'll see. Really, if we take out the high of last week, 28.60.31, then basically all systems are a go to challenge that old high at 29.40.91, and probably well beyond that if we get there. So we'll just have to look at the short term, watch these key levels, and no big trades until the market kind of tips its hand as far as what direction it wants to break out in. Okay, that being said, we'll go to the Dow Jones Industrial Average. And looking at the Dow, fairly similar, although a little bit different from the other two indices. The Dow definitely making lower highs, but also made its first kind of higher low here on Monday. And we've been just doing choppy trades since then. But now today we've got a gap up and a close above the T-line. So I'd say on the Dow here, if we get above this level on the Dow, and that's at 26,109.68, it's pretty likely that we're now on a breakout. And the Dow already has a golden cross, as I think I pointed out in last week's video. So, yeah, I mean, unless this thing can start selling off right away, as long as we stay above this daily T-line, and we hold this level down here, at 25,372, then things do look bullish. Now on the weekly chart, the Dow also did a, let me just make sure it did a bullish engulfing here. So we closed last week at 25,502. We opened this week 25,490. So yeah, we opened lower, closed higher than the real bodies there. So the Dow has a weekly bullish engulfing candlestick as well. But again, we need to get above last week's high. Again, 26,109.68. If we get above last week's high, I think for all the indices, that's a great indication that we're going to, be making a challenge for these old highs, old all-time highs. But again, I think short term there could be a little bit more friction before that happens. Okay, now on the NASDAQ composite. So NASDAQ composite, very similar to the S&P. The two really look more similar than the Dow do at this point. Sorry, than the Dow does at this point. But you can see even on this little daily chart, we have this decent move down, and now we just look like we have an ABC up. And fairly indecisive candles, doji. That was an unusual candle. Technically a bearish engulfing, but with a long lower shadow. Doji, and then today maybe a bullish hammer, but again, haven't broken any key levels to really signal a big breakout. So I'm still favoring that we need, if we have A down, this is ABC up for B, we need at least that C wave down, and maybe come down and touch that 200-day moving average if that was the case, and then launch again. Or if we really start going well below that, then maybe we got a 1, 2, 3 in progress, just like we're working there on the S&P's shorter term wave chart. Now on the weekly here for the NASDAQ, also a weekly bullish engulfing candlestick. And to invalidate this candlestick, we'd have to take out this week's lows, which is at 75, 79.29. And to invalidate last week's bearish hammer sell signal, that would be taking out 78.50.11. And again, that would open the door to a likely move up to new highs and beyond at 81.33.3. But we'll have to just see how this unfolds. Next week should probably decide the direction for possibly quite some time thereafter. Okay, now on the VIX. VIX really isn't breaking out here. It certainly showed some early signs of life, but again, it made another lower high. So I wanted to see it get above that 1833 level to kind of signal a bit of a breakout here, a break of this downtrend. And we got up close. We got to 1785, but you see we made another lower high, and now we're backing off again. So the VIX really being indecisive here, not really giving a whole lot of clues, other than, well, a VIX that just can't break out to the upside is a fairly bullish condition for equities. So that's currently kind of the situation there. And if we look at the VIX VVIX tool, when we start getting really choppy here on the market, and sorry, it looks like for some reason the data isn't coming in for VVIX, possibly because there's some weekend maintenance going on with this platform or whatever. But basically, we lost that red moving average on VVIX. We're back above the blue moving average on SPX, although there could be the ingredients of another sell signal kind of building up here. But I can't really show you VVIX and VIX to see if there's any divergences between them starting. So I'll just pass on that for today's video. But basically, the bottom line is some mixed signals on the shorter term wave patterns. Looks like we do need at least one more leg down. But if you just go by these daily and weekly candlesticks, looks like we might just be ready to go up basically immediately. So we'll have to see what next week brings. Certainly I like, going back to the wave chart here, I definitely like this as far as a trade setup goes, just because of the risk reward. And if you get stopped out, you get stopped out. You're risking 25 points to try and make 75 or more. But as far as risk reward goes, it's pretty attractive. It's basically around 3-to-1 risk reward with that target, and the probability of getting another leg down seems pretty decent. We have a 5 down. We currently look like we have a pretty textbook 3 up, and that argues you need at least one more 5 down to complete the correction, if it is just the correction. So I'll kind of end on that. Short term, cautiously bearish, but bigger picture, it's just not that clear right now. And no need to change the wave counts as of yet, as I mentioned before. All we really know is that we have some sort of 5-wave structure in place, and now we're waiting to see how that transitions. Do we just get that 3-wave decline and then start a new wave up, or do we get something more substantial, and do we go down and really go after those December lows? At this point, I know we're so far above it, it seems unlikely, but prepare to be surprised. Anything can happen. All right, Serial Trader signing off.